Yeah, you know, over the last 4 years, obviously the world has changed in the financial markets too. Rates have continued to come down. The Fed is doing QE1, QE2, QE3. You're at artificial low rates, 0% basically in many cases. And, at our practice especially, we have a lot of people who are kind of middle-aged, have made a lot of their money by now, and are looking to preserve it. So diversified portfolios of stocks and bonds are what we put together, but a lot of people have that income need or income component. And with government yields where they are, the question is how do you add on to those low yields, depending on how much risk you're willing to take, obviously, to do it. And there are really three types of risk within the income needs. You've got credit risk, which is anything once you're moving out of government bonds and out of AAA mortgages, you're taking credit risk, which is the additional risk that you want to get compensated on for taking on the less creditworthiness in the U.S. government. You've got duration risk, which is really a form of interest rate risk. It's the sensitivity of your holdings to potential rises in interest rates. Now we're levels in interest rates right now, where chances are there's only one way to go from here, which is up. The question is when, and that's a whole different issue we can talk about. And then the third thing is convexity risk or prepayment risk, which is mostly inherent in mortgage-backed securities, as well as corporate securities as well, too. So you've got to look at what you're getting paid for owning a particular instrument versus what the chances are of losing that instrument in the near term or at a time when you don't want to lose that coupon. You buy a big coupon, and what happens is what's good for you is bad for the company, so they're going to look to take it out of your hands at just the time you don't want to do it. So these are the different types of risks involved. We constantly are evolving how we do things, depending on what the rate outlook is, and depending also what our outlook is for credit and for the equity markets as well, because equity markets drive credit too. As an example, in 2008, we moved a lot of clients out of corporate bonds. We were low and high yield. We moved them out of corporate bonds and bought Ginnie Maes back then, government-backed mortgage backs, which was the right trade to do. 2009, 2010, the market started coming back. We started swapping out our mortgage backs. We were a little bit chicken about getting into equities too soon, because after the beating that most people took. So we moved our money back into corporate bonds, which ended up actually returning almost as much as equities those couple of years. But remember, you're much higher up in the capital structure doing it. The bondholder is senior to the equity holder. Consequently, after that, by 2011, we started moving slowly, shifting money out of treasuries and corporates more to high yield. And the last year and a half, we've gone pretty heavily into high yield, which last year was a great trade also. High yield was up almost as much as S&P. It was about 15%. S&P was about 16%. Now we're at an interesting point because you've had that big run, and we knew full well the end of the year, all right, what's the next step? What's the biggest risk here? So we knew full well the juice in high yield and some of these other spread products. Corporates we started moving out of last year anyway, because even then the yields were coming down. And corporate spreads right now are just, investment grade spreads are not at all attractive. So the question is, what do we do? What we've done in the last 6 months strategically is, one, look for where we can get yield without taking that interest rate risk. So what we've been doing is staying more or less in the high yield space, but more or less the higher quality end of the high yield space, meaning the investment grade bonds are triple B, single A, double A, triple A. Below triple B is considered high yield. So the double B space is right below it. And that's kind of an unsponsored area, because in the world of fixed income specifically, investment grade mutual funds cannot buy anything below triple B. And most high yield funds want more yield. So they're buying more like at the triple C, the low single B area. So you get that better quality area in between, which tends to be unsponsored, tends to be a little bit more inefficient, tends to be a place where you can find value. And the other thing we're combining with that is buying mostly maturity of 3 to 5 years max. So we're keeping that duration short as well. And the thing is, for instance, a 5-year corporate bond now yields about 1.5% of a good quality company. Well, a 5-year corporate with a 1.5% coupon has a duration of about 4.7, which means if interest rates rise 100 basis points, you're going to lose more than 4.5% of your principal amount in a 5-year corporate. When you're buying high yield bonds, because you've got more of that yielding cushion, that coupon cushion, the high yield bond currently is yielding in that maturity, that 3 to 5 year, as cheap as 5.25%. But the duration's there, are shorter because the coupon income is a bigger percentage of your return. So if your duration there is 2.5, probably about 2.5 to 2.75 years, if you get that 1% interest rate movement, you may lose 2.5% on your bond, but you got a 5% yield over return. It's you actually have a positive return of 2.5% versus losing money on that one. So that's a big part of what we're doing. We're basically we're looking for that. That's kind of our sweet spot right now. And we've got a credit department where we get all our credit research, so we know the credits we want to buy, etc. And then the flip side of it is we combine that now with a barbell approach. So what we're doing is we're buying some of these short corporates, and we have a lot of clients who want income. Well, 4 or 5% is fine for some people. Some people need more. So what we do is we start throwing in some other things, mostly things like preferred stocks, and there are different kinds of preferred stocks. But the typical 30-year or 40-year preferred stock is a long duration. But the sectors we're buying there are areas called mortgage REITs, business development corps, and some high yield preferreds as well. The yields there are closer to 7.5% to 8.5%. So with the clients that don't need to withdraw any of their principal from their portfolio, in other words, they can live off their portfolio income, we'll put a 10 or 15% weighting anchor in that kind of stuff to boost the yield, with the idea being that with the rest of the portfolio being more of those short maturity bonds, every couple of years they're going to be maturing and rolling off. So as interest rates move higher, cash is coming into the portfolio to invest in higher yielding bonds as time goes on, and this little anchor here is still kicking off or helping kick off what's necessary to support people's, if it's their living expense or whatever they have. So, and every client's different, but the point is that that's kind of the way we've been doing things more or less. Now, to supplement that as well, master limited partnerships, which are not bonds. They're not fixed income, they're kind of a hybrid. They're an equity, they're actually an equity component in the sense they trade in the New York Stock Exchange, but they're actually units in limited partnerships. The MLP space was created in 1986 by the government as an incentive for energy drilling and exploration for natural gas and oil. So a lot of the oil companies started these MLPs to do that. And the key components here of MLPs is a couple of things. One is that they kick off a lot. What they tend to do is kick off a lot of depreciation. Let me back up. There are different kinds of MLPs. The energy space, which is what I'm talking about, has what's called upstream, midstream, and downstream. The upstream guys are basically the downstream guys. No, I'm sorry. Let me come back. The upstream guys are the explorers and whatnot. Okay, they're the ones out there drilling, et cetera, et cetera. The midstream guys are the transportation companies. These are the guys who build the pipelines. These are the guys who store the gas and whatnot. They basically are toll takers. What they do is they sign long-term contracts with the exploration companies to deliver that gas through pipelines to the end users, the refiners, the gas stations, etc. So it's kind of a utility almost of sorts. So it's a space which we've gotten to know a number of big managers that manage MLP securities, and we use some of them to manage some of our space. A lot of it now we do our own because we've gotten to know a lot of the credits very well. There's other kickers with the MLP space also. 90% of their activity has to be energy related. And the other thing also is that you don't get taxed on the distributions. They have to pay out 90% of their distributions. On top of that, they don't pay taxes at the corporate level. So you don't have this tax drag. There's a lot more cash left because, as you know, regular dividends of the corporation, they're paying the corporate level than the individual pays. So when it's all said and done, you're paying 70% is going to the government. Here it's only the individual's tax rate. That's number one. Number two also is because of all depreciation and depletion that kicks off from all these pipelines, all these assets in the ground, you get a huge tax deferral. So what happens is typically 80% of your distribution from an LP is tax deferred till you sell your units down the road. So you get a distribution. As you get your distribution, you're only paying 20 cents to the government in taxes. The rest of it is tax deferred. So on an after-tax basis right now, most MLPs range anywhere from 5% to 7.5%, so on an average 6%. It's like buying a municipal bond because out of your 6%, you're only paying 20% in taxes, so it's a 5% kind of after-tax yield, which is in units, which also are growing. Most of these MLPs, the better ones have tended to grow their distributions in the area of anywhere from 3 to 8% a year. So on top of MLPs being an income component, they're also a good inflation hedge. Because if rates do start moving up, you've got, if rates go up 3% in the next 2 years, most of the distribution increase to you is going to more than offset that. So there's a couple of different things working with MLPs that from our standpoint, and most people would realize that it's a good supplement to some of these other types of income things we're talking about in the fixed income market. MLPs, as an example, by the way, last year were up about 2% for the year. Most of the reason they were suppressed was people worried about the changes in tax law at the end of the year. They were worried that it would start, this tax stuff I'm talking about right now would start being reversed out, et cetera, et cetera. So that's why they were there. First quarter this year, MLPs, the Laureate index was up like 19% for the quarter, which is ridiculous, obviously. But a lot of it was catch up from last year. And I think a portion of it now, too, is people realize that if tax rates do start going up, this kind of security from a tax standpoint is even more valuable. And on top of that, and you've probably read recently, they're talking about the U.S. being energy independent possibly in the next 5 to 10 years. Marcellus Shale project and a number of others are big projects that these MLPs are going to be building out the infrastructure for in the next 5 to 20 years. So there's going to be a lot of demand for this stuff. So in general, we think it's an asset class that we've been made a kind of a permanent part of people's portfolio. And as I said, these kind of yields supplementing some of what I said before. The correlation of MLPs to the S&P historically is 0.4. So you don't have that. You don't have the equity type risk necessarily that you do with dividend yielding stocks, which I know they've done well. I mean, dividend yielding stocks, the first quarter, I think we're up about 14%, which beat the S&P as well. But the fact of the matter is that they come to a point too where it's an overcrowded trade. They get overvalued, and they're equities. I mean, that's what it comes down to. So you do have equity risk there. If we have a big equity correction, they'll cushion, maybe not go down as much as some of the higher beta stuff. They will correct. MLPs in the long run, in the last 20 years, only 2 years have they underperformed the S&P 500. 2008 was a terrible year for MLPs. Not that it was related to the MLP space. What happened was a lot of credit hedge funds loaded up on them. They were buying these MLPs with the yields of 6, 7, back then they were 8, 9, 10%, and using short-term money and just clipping the spread. And as you know, when all of a sudden all the banks start calling the credit lines and this and that, and the hedge funds are blowing up, they had to liquidate this stuff. And the liquidity in MLPs is not, the bigger ones have good liquidity, the smaller ones not quite so much. So it doesn't take a huge amount of selling to really knock the prices down a lot. And in fact, what we saw was about, I think it was 40% decline on the MLP side in 2008. And they were up 75 to 80% the following year. The S&P, I believe, was up 25 or 26. So they came back because it was a very artificial, and it was forced selling. It wasn't, in fact, none of the MLPs cut their dividends. In fact, their fundamentals didn't change, whereby the smart money, if they bought back then, the yields then were they were double digits. Anyone who bought back then, is sitting pretty, even if they didn't sell it, they've got a cost basis that is very attractive. So the bottom line is that it's a space which is not correlated, and we look for things which aren't highly correlated to everything else. So that's a space which again, it's not fixed income. It's kind of a hybrid, but it's a great provider of income for people who want to buy things that, and as I showed you too, you can make money on it too. They were up what they were. We think over the long run that they will continue to generate, anywhere from kind of mid-single digit to low double-digit returns over the long run. And if you realize you're getting a 5 or 6% dividend, and you add another 5 to 10%, mid-double-digit returns over the long run could be very conceivable with this stuff. But in the meantime, you're pocketing your nice after-tax yield with it.